Today is Tuesday, the 13th of June. This is a recap for the stock market activities today. Now folks, I got a good one for you tonight. Let's begin with this. Here's a really good comment from a friend of the show. He says, great video last night, meaning the weekend video. And regarding the different this time, quote unquote, because I showed a lot of recessionary indicators. The viewer says, how do we stack up this with the charts you mentioned in the In Focus section? And the chart he's attaching is construction by manufacturers in the US, and it shows a massive spike. So you're going to look at this chart and say, what recession? What are we talking about here? This is far from a recession. We're talking about a boom in construction in the economy. Now understand this. We've been talking about the icy hot phenomenon in the economy, and I happen to be in team stagflation. Now in the last video, I showed you some recession indicators, but I can show you a lot of inflation indicators, including this one. The combination of both gets us the icy hot economy. And the trick for the Fed is to get everything in the hot category to join the icy. And at the same time, make sure that the icy stays icy. But there is a catch. The longer the Fed plays the game of, oh, we're going to skip, we're going to pause, we're going to do 25 here, 25 there, what happens? We could see the hot getting hotter and the icy getting icier. And then the gap becomes wider and it becomes really, really hard for the Fed to do the job. Another outcome could be a lot of the icy becomes hot again. And perhaps in the CPI today, we got some of that, or we saw some of the core goods inflation actually ticking higher by a tiny bit. You see, at the end of the day, whatever the Fed does, it will impact the economy and the stock market one way or the other. Choice number one, and this is what the bears were betting on, and maybe still betting on this year, which is the Fed will walk the distance. The Fed will do the job, and in order to do the job, they have to continue to raise rates higher and higher and higher until we see a break in the unemployment rate, but most importantly, we start to see some job losses in the economy. That is the moment when the Fed stops and reverses policy, and we start to see the beginning of the recession. Now, the problem this year is the hot side of the economy is really, really strong. Be it construction, be it travel, be it services, and it would take the Fed a lot more to break the back of inflation. If we thought that 5.5% would have done the job last year, now we have to look for 7% plus. And the question now becomes, will the Fed actually do the job? And perhaps this is why the bears are disappointed this year. Because the other outcome, the other scenario is, so long as the headline rating and inflation keeps going down, the Fed cannot really justify going all in aggressive to crack the hot side of the economy, spike the unemployment rate higher, create job losses in the economy to achieve a knockdown win against inflation. There are political reasons, there are a lot of things on why they can't do that. Again, I'm not saying they're not going to do it, but so far it appears that they're not going to do it. And in reality, they will go with the other outcome, which is at some point, the Fed will relax, will say, okay, we've done enough, we have to wait and see, because there is a combination of two things. The icy side of the economy became too icy, and we started to see some systemic risk in banking. And the hot side of the economy, okay, it's still hot, but it is sticky more than it is getting hotter. So the Fed relaxes and says, okay, maybe we take a pause, we take a breather now. The problem with this approach is we will see re-inflation in the economy. The hot will become hotter. The icy will move back to the hot category. And then the Fed will have to catch up and resume doing the job from a less fortunate position, and that would be the final blow to the economy and the stock market. So two scenarios. One is finish the job, crack the economy, get a recession. The other is relax, allow stagflation to go on, and we see re-inflation in the economy in certain categories, and then come back and do the job from a less fortunate position and crack the economy once and for all. Why are these two different outcomes important for us to know? Because in scenario number one, we see job losses, the economy goes down, the stock market crashes. But in the second scenario, the economy holds, and we see the stagflation phenomenon. And in this scenario, the behavior of the market will be completely different, where we could actually see the inflation kind of stocks, the commodities, the metals, the oils, the cyclicals coming back. And in that scenario, the stock market goes higher because we have more participation. And this is what this whole rotation theory is all about. Do you want to get the pain now, or do you want to get the pain later? And by the way, when we look at this chart and we zoom in a little bit, look at what happened just before the last recession. We have seen construction booming, and then it went down crashing. And of course, the circumstances are different between now and then. Back then, we got a lot of mania in the housing market due to the subprime mortgages. At the end of the day, the net impact is the same. We have a surge in demand in housing with very little supply, and this causes a construction boom in the economy. Of course, we all know what happened in the aftermath to these home builders. They overpaid and they lost a lot of money. A lot of them went bust. This time around, we don't have the subprime mortgage problem. The majority of mortgages are meeting excellent credit conditions. And with rates moving higher, we have even more restrictions to prevent the kind of risk-taking that we've seen before. But right now, after a decade or so of quantitative easing, a lot of folks built up a lot of savings for the down payment on a house. So we see a lot of folks have $200,000, $300,000 in their savings, and they're waiting to buy a house. The problem is the supply is no longer available. And the reason is, number one, nobody wants to sell once they secured lower mortgage rates. You don't want to sell and then find yourself having to buy a new house with triple the mortgage rate. Number two, we've seen a lot of these so-called investors. A lot of them are foreign, by the way. A lot of them are companies, institutional investors. They've been scooping single-family homes across the country and turning them into rental homes. And that killed the supply too. So we have different dynamics, but the end result is the same. Now, how do we crack the back of this and end this inflationary cycle in housing? The answer is, you have to increase the unemployment rate significantly higher. With that, inflation dies. And with that, we see the housing mania coming down and more availability in housing, which is why it's kind of ironic, but we have a lot of folks across the economy cheering for a crash and a recession. We've never seen this before in America, but we're seeing it right now because you have the Gen Zers and the millennials pretty much pushed out of the market altogether. They want to see a recession. They want to see a crash. And of course, everybody hopes that they will be the survivors. They will keep their jobs and their savings. Anyhow, I hope this was helpful to you, but if you look at the chart for DHI, for example, D.R. Horton, a home builder in this country, look at this, a monthly chart, all-time highs, because we're seeing an actual, tangible boom in housing. Of course, if the Fed does the job and raise rates enough to increase unemployment in the economy, then the stock comes down crashing. But it is a reflection of what's going on in the housing market. It is inflationary. It has never been in a recession. Last year, you read the headlines, oh my God, housing is in a recession. It's crying uncle. All of that is bullshit. Folks, we're just waiting for a better opportunity to buy. So the aggregate demand remains really strong in housing. That's inflationary. And if we look at the CPI that we got today, it gave points to both the bulls and the bears, depending on how you look at it. Of course, the bulls would look at, oh, look at the headline reading. It's down to 4%. Sure, it's double the rate that the Fed wants, but it's close enough. It's time for a pause or a skip or just end rate hikes altogether. The bears would look at this and say, look, when you look at the categories, one by one, month over month, you take away energy, and then you look at services, less energy services. Year on year, the inflation rate is actually 6.6%, and that is alarming. You look at certain categories, such as used cars, up 4.4% month on month. We look at medical care commodities, up 0.6% month on month. The last reading was 0.5 percentage point month on month. So we see inflation going on here. We look at shelter. It went down to 0.4% last month. Now it's back up to 0.6%. So we see inflation in housing. And the moment the Fed backs off, these readings will go back to 1.5%, if not 2% month on month. You look at transportation services. Last month, the reading was minus 0.2% month on month. Now, it's up to 0.8%. So again, we have alarming indicators that the fight against inflation is not over. And the moment the Fed backs off, we will see reinflation in the economy. And the construction chart that the viewer showed us is just one evidence that the inflationary pressure in the economy is still alive. It is just backing off, retreating, because the Fed has been taking action. The moment the Fed backs off, inflation is going to pop its head again and say, hey, I'm back. Let's get the party started already. Would you like to see CPI 10% in this country? Let's go. And by the way, I tried to do some charts for you, and I asked AI, because AI, they say that AI is worth about, what is it now? $15 trillion? Well, here's $15 trillion for you. I went into ChatCCP and I said, can you create a chart for the month-on-month inflation reading for each category in the Consumer Price Index using the latest report released today? ChatCCP says, I apologize, but as an AI language model, my responses are generated based on pre-existing knowledge up to until September 21. Therefore, I don't have any access to the latest. Okay, what about the other one, Bard? Same question, and all what Bard did is went to the BLS, Bureau of Kitchen Statistics website, did not provide a chart at all, just cut and paste the same information and gave it back to me. So that's AI for you, the $15 trillion revolution that we have to jerk off to death, because God forbid you might miss out. But again, you look at all of these categories, you take energy out, and it is an abysmal reading. It's not a good reading. Inflation is still too high. And by the way, do you remember back last year when the bulls were saying, hey, you got to strip away energy. That's too volatile. Strip away energy. And inflation is still good. It's not really that bad. Now, all of a sudden, when the bears say, hey, let's strip out energy because energy went down. And that's not really where inflation is. Let's use everything X energy, like services, less energy, for example. That's up 6.6% year on year. All of a sudden, you get accused by the same people of, oh, you're cherry picking here. Inflation is going down. It's getting crushed. Oh, by the way, what happened to the lag impacts that you people have been talking about since last year? Oh, the Fed got to stop because of the lags. The lags. All of a sudden, the lags don't matter anymore because we got AI. AI takes care of the lags, but somehow cannot answer a simple question. Now, if we use the crystal ball and we say, okay, us bears, we got it wrong because there were two outcomes. We were betting all in on outcome number one, that the Fed will do the job, crack the economy, increase unemployment, we see a stock market crash. But the Fed is not doing the job. And the job means 7% plus interest rates, which means we have scenario number two, which is stagflation. What is the moment that will rattle the economy and the stock market? If we look at the month-on-month readings of the CPI from last year, and we want to study the base impacts, because 4% is only possible because of base impacts. Well, in May 22, June 22, we got high readings of the CPI, year on year, month on month. So the base impacts will suppress the readings that we got today, and we're about to get in the month of June. But after that, you got to remember, services inflation today, this year, is higher than last year. So if you're going to pin it against a zero reading from July of last year, all of a sudden CPI could move from 4% all the way back to 5 plus. August, same story. And that could be the nail in the coffin. If the Fed pauses tomorrow or skips and then reiterates in the next meeting and says, okay, we're going to pause altogether. Sure, the market will go higher. It's going to be led by the rotation trade, the commodities. And then comes July, we get the CPI for July, whoops, CPI is back up above 5%. Then we got a massive, massive problem. Now, we're not shutting the door entirely on scenario number one, which is the Fed will do the job. For all you know, Jay Powell could come out tomorrow and says, hey, joke's on you folks. Did I say skip? Never mind, I meant actually 25 basis points. Because while the headline readings is down, you look at the core CPI reading, it is sticky. You look at this chart, you cannot justify a pause. You cannot justify a skip. You cannot justify anything. You can only justify more aggression by the Fed. Because the only way this is going to go down is if the Fed comes out tomorrow and says 50 basis points and then another 50. We're going to go all the way, like Jamie Dimon said, to 7% plus to take this down. Now again, is it the likely scenario? The answer is not really, because the Fed is afraid if they do the 6% plus 7%, you're going to see banks collapsing, you're going to see zombie companies blowing up, you're going to see commercial real estate, residential real estate collapsing in this country. No, by the way, the federal government, how much are we paying in interest right now? Think about how much we're going to pay if interest rates move all the way to 7%. What happens to all of that credit card debt? The highest on record. If the Fed moves all the way to 7, the credit card companies will move to 40%. And again, folks, I say the understanding of these two outcomes is really important because our market strategy is going to differ entirely. If the Fed pauses and allows reinflation in the economy, you have no other choice but to chase the rotation. If the Fed doubles down and says, okay, we'll do 25 basis points, forget about the skip and the pause, then we're going to stick with scenario number one, and all of what happened in the NASDAQ so far is just a mania bubble that will go down crashing. And the strategy will be shorting that, along with banks and commercial real estate, zombie companies, etc., etc. Two different strategies, folks. And again, there is a lot of support for the Fed to raise by 25 basis points tomorrow. I don't think they're going to do it, but what if? Because you look at US Supercore CPI, for example, that's moving higher again. So if you want to look at it from the lens of they got to do the 25, you can find plenty of supportive evidence. If you want to look for the pause and the skip, you can also find plenty of evidence, mostly in the headline and energy inflation. And that leads us to Powell. See, this is Powell from Jackson Hole. Clean shaven, fresh haircut, looks pretty good, looks young. He got the Starbucks coffee cup in his hand. That's the kind of guy we want to see. That's the kind of guy that reflects confidence. Not the guy that we've seen recently, shaking, twitching, drooling all over the place. Because that's not Powell. That's Powell reflecting the orders of his handlers. And we want to hear from the man himself. We want to hear Jackson Hole Powell. We want to hear fresh haircut, Starbucks coffee mug Powell. We don't want to hear the handlers. And therefore I say, if anybody from the Fed listening right now, you got about 12 hours to do this. But you might want to go to the weed store, get an edible, get something. They have these things that you could put in your coffee. Slip it to Powell. Get him stoned tomorrow before the conference because he's going to need it. You know why? Because if he decides to skip, despite the employment report that we got recently, despite the core CPI that we got today, and God knows what the PPI is going to look like, despite all of that, if he skips, the question is going to be, what is the point from the skip, Mr. Powell? If you're going to raise in the next meeting, why play the games? What is the point of the skip? What will be achieved by the skip right now? And he thinks that he got a good answer, but he doesn't. His answer is going to be, oh, we have a lot of credit tightening in the economy and by banks. We have to take it easy and see and look and assess. But it's not a pause. It is just a skip. Do you really think anybody's going to believe this crap? And this could rattle the market, folks, because we could see sell the news or everything gets sold and we see the rug pull scenario. Or if the market buys the skip, we could see the rotation trade accelerating tomorrow where the IWM gains, the Qs get sold off. Of course, the other less likely scenario is if Powell grows a pair, comes out and says, you know what, we're doing the 25. Then the market crashes, no doubt about it. And no rotation either. But that's less likely. Now, a lot of you say, hey Maverick, why do you talk positively about the rotation? You did not like the NASDAQ rally, the AI mania, all of a sudden you're into the rotation? What's going on here? Number one, when you look at it from the money manager's perspective, you had an abysmal year last year. You're about to lose your business. So this year, if you wanted to make up some ground, you push the AI mania, the big caps. All the managers get together, say, hey, look, we got a bad year last year. We're about to lose our jobs. Let's buy the big caps and pump them higher. And if the clients grab the phone and say, what are you doing here? What about the Fed? What about the recession? We can brush that off and say, but the big caps are actually safety. The big caps are actually defensive. The big caps have a lot of cash. So you don't have to worry about them. They're actually good valuations right now. They went down big last year. And oh, by the way, we got this AI mania thing going on. So you can sell that easily as a money manager. But when it comes to the rotation to oils, to metals, to fertilizers, to cyclicals, to banks, you can't sell that easily. The clients will grab the phone and say, what the hell are you doing? Don't you see what's going on with the banks? Don't you see what's going on with the recession? Don't you see what's going on with China? It is a harder sell. So if there is a rotation to the cyclical side of the economy, it is happening via strong conviction. It's a lot of risk, and the money managers will not take that risk unless they're really, really convinced that this is going to work. And if you wanted to be cynical against the rotation, the biggest reason was China. We have a lot of economic weakness in China. How could you justify buying the Caterpillars, the Deeres, the steel, the metals, the fertilizers, the oils of the world? You can't do that without China being healthy. And China right now is sick. Well, today we got some good news, quote unquote, good news from China, that they're issuing more stimulus. They're pumping the Chinese economy because it is dead and it needs revival. And therefore, today we saw commodities, specifically energy, crude oil commodities, shot up higher, a big recovery, along with nat gas and the rest of them. This could provide ground for the rotation. The managers would look at this and say, hey, yeah, buying the industrials, the Caterpillars, the Deeres, the Boeings, the metals, it doesn't make sense right now. But maybe it does, because China is re-stimulating the economy. So the China excuse is out of the way, at least for now. All we need is the Fed to back off. So what are you saying, Maverick? Do we just go all in, the IWM right now, all in, buy metals? Hold your horses, hold your horses. A, you want to see my strategy in a minute. B, you want to watch the charts analysis because the chart of the IWM is actually facing severe resistance and it could pull back big time tomorrow, one step at a time. When we look at the sentiment in the market, for example, we begin the year with mostly bears, not above 50, but the predominant voice was bears. That the Fed will do the job, they're going to crack the economy, market is going to crash. And if you happen to be a contrarian and you took the other side of this, you got rewarded by the market, specifically if you went long the AI mania. And you can see in the aftermath of the collapse of SVB, the bears actually got all the way almost to 50%. That was too much. And the market rallied, despite the fears about a systemic risk. Now we have the opposite problem. We have a lot of bulls. We're almost at 50% now bulls. And the bears disappeared. This is exactly the most dangerous time to buy the Qs, to chase any rallies, Dow Jones, S&P, Russell, rotation, anything. So you have to be really, really careful. You gotta wait till the Fed gets out of the way. Because right now we have a lot of hype I was watching CNBC and the CEO of AMD was on, and she says, oh, the chip market, the AI chip market will be whatever $1 billion in the future. We have these gigantic orders coming. And to her credit, the reporter actually asked her and said, which company is placing these orders? Hundreds of billions of dollars. The CEO of AMD refused to answer. And we talked about the CEO of NVIDIA saying, oh, our revenues are going to climb from 7 billion to 11 billion, but did not give a name either. And we have seen that kind of behavior before. Just last year, they were talking about the metaverse. That was the hot topic. Forget about AI. It was the metaverse. The metaverse is going to be at whatever $1 trillion by whatever year. All of these hypes work the same way. And right now we have strong evidence that this AI thing is just a hype. We see some tangible results in forward pull demand, such as we've seen in Oracle, for example. So the bottom line is you gotta be really careful. The good news is you got a little bit of time before Powell comes out. So here's what we should do. Let's say you've been long the AI mania, the Qs. A lot of you are long the Qs. So here's the strategy. You want to sell the 375 calls. And again, you can pick your own number. I'm just looking at the charts and I see 375 as pretty much impossible to trade above by July 21st. So why not sell those? And we get $4 a piece, and then we use some of those proceeds, and you buy the 363 puts, which is pretty much on the money right now, with the expiration date of this Friday. And what you're doing right now is just buying protection for this week, in case we get a rug pull scenario. And if you use this strategy, you're going to walk away with about $1 in credit. So you're going to get paid to protect your positioning. Now, if you happen to be net bearish, the Qs, for example, or the market altogether, your risk is, what if Powell actually reignites the rally? And the majority of the rally will happen in the IWM and the rotation side of the economy in the stock market. You already have some shorts, so how do you hedge against that? You can buy this Friday's TQQs 41 calls. It will cost you about $0.50 a piece. And why would you buy that? Because you short the Qs. You short Microsoft, you short Meta, you short whatever you're shorting. Your hedge is, what if we see a massive explosion tomorrow? We see the Qs up 3, 4, 5% for whatever reason. That's your hedge right here. On top of that, you spend another 50 cents or so buying the 38 calls on the TNA, which is the leveraged index for the IWM. Same expiration date this Friday, in case we have a massive move toward a rotation. We see the IWM gaining. All in all, this hedge will cost you altogether $1 a piece. That's all. The other thing you want to do is you got to have some exposure to volatility. Whether you buy the VIX or you buy proxies of the VIX, because there is a high chance that we will see the VIX exploding higher. Why do we say that? Of course, we have the Wednesday's VIX options expiration tomorrow. Besides that, the most important expiration is quad witching on Friday. You look at the calls, look at the open interest here, and we're seeing massive volumes showing up. If the VIX trades above 15 as we near to Friday's expiration, we will see a massive squeeze in the VIX. All of these contracts have to be covered for. On the other hand, when we look at the VIX puts with the expiration date of this Friday, most of them are already in the money. And the question becomes, will the market maker short the VIX at this point with these massive numbers? Or, now that the VIX is oversold, they want to go long volatility? I think the answer is clear. I think the risk is clear. Sure, the VIX can go down back to 13 by the end of the week. But is that the most likely risk? Or is it for the VIX to explode higher? I think the answer is clear. So you gotta have some exposure to volatility. Anyhow, let's move on and talk about the market. And we begin with the closing of the indices today. And here we go. The Dow Industrial Average closing positive by 145.79 points, or a gain of 0.43%. The Nasdaq leading the pack, up by 111.40 points, or a gain of 0.83%. The S&P 500 also positive by 30.08 points, or a gain of 0.69%. We look at these sectors, again, much better rally than we've seen before. It is sort of a rotation kind of day, although energy got weaker by the end of the day, but the end result is a rotation. Metals at number 1, that's what you want to see. Cyclicals at number 2, industrials at number 3, financials also rallying. But of course, you'd like to see more outflows out of technology and communication services. Then we get more of a confirmation that the rotation is real. We look at the breadth all in all. Again, you're not seeing the Nasdaq or the market altogether up 2-3%, but the breadth is really good. NYSE 75% advancing versus 24% declining. The Nasdaq 66% advancing versus 31% declining. We look at futures. Here it is. The dollar was down, supposed to be good for metals, but we see gold, silver, platinum all down. That's kind of shady. Maybe it is an indicator that the dollar is playing a trick today and it's going to pop higher tomorrow. Why would it pop higher? The only plausible explanation is Powell coming out hawkish more than we think. Anyhow, copper was up though. That's good, but maybe it is related to China because we see crude oil up by 3% apiece, be it the WTI, be it Brent. We see nat gas also up about 3%, heating oil up about 3.5%, gasoline, RBOB up about 2.5%. So that could be China related. And then we see some improvement in lumber when it comes to softs. We see some improvement in meats, some improvement in grains. And I want you to keep an eye on wheat because we heard from Putin today, and he suggests that perhaps he's going to leave the grain deal with Ukraine. So how do we play that? You look at the chart of the ticker WEAT, wheat, which is a fund for wheat and many other grains. A lot of you don't trade futures, so I'm using this example. You look at the weekly chart, it is turning around from bearish to bullish. We have a crack above a sloping line of resistance. We see the MACD improving. So why not buy the $7 calls for the ticker WEAT with the expiration date of July 21st? It'll cost you about 15 cents a piece. But that's your play in case wheat spikes higher because Russia pulls out. Moving on to options, the big casino, what do we see here? The volumes all in all are actually down a bit. Not by a lot, by a little bit, which shows that a lot of players are actually waiting until the Fed gets out of the way. But we do still have a lot of risk here. A lot of folks buying a lot of calls, not puts, plenty of calls out of the money with the expiration date of this week. You see the calls above 60% for the top 3 names, Tesla, Nvidia, AMD, even Apple, and it gets as high as 70% for Amazon. So there's a lot of chasing here. And when everybody's chasing, it becomes really dangerous. You gotta go the other way. And speaking of, here are the unusual activities that took place in the options market today. We begin with the ticker TSLA, Tesla, under a gamma squeeze. But boy, it's getting really, really dangerous. You look at that RSI on the daily chart. I know people keep saying, oh, but the RSI doesn't mean anything. It just means that it's overextended and it's really strong and it could go higher and stay overbought for a long time, yada, yada, yada. But it also means when it's over, it's going to be an insane pullback. Because if it does work, and we see Tesla at 300 by the end of the week, then the market maker will be absolutely devastated. And we know that the market maker always wins at the end of the day. And they're going to deliver a massive surprise to these call options holders. Either you booked your profits or you're the Johnny-come-lately waiting to be slaughtered. Now, the shorts got to be careful too, because it might happen tomorrow. Tesla might crash tomorrow. It might happen by Friday, but you don't know exactly when. And there could be a lot of pain until that happens. And the reason is we see insane, I'm talking insane inflows. Stuff like we've never seen since 2020. Look at this trade, for example. Somebody bought the 290 calls for the expiration date June 30, with expectations that Tesla will move higher and gain more than 12% by then. They paid about $3.75 a piece. Tenor. This trade, all in all, spending about $9 million. Crazy stuff. You look at the SPY, we have a put spread here. Perhaps somebody buying some protection or maybe betting to the downside, who knows. They bought the 385 puts and they sold the 355, all for the expiration date, July 28, with expectations that the SPY will go down and lose more than 12% of its value by then, but not more than 19%. They paid about 80 cents a piece for buying the 385 puts. They received about 40 cents a piece for selling the 355 ones. All in all, the entry cost is about 40 cents a piece, and the total spent for this trade is about $700,000. And then we have the ticker MANU, Manchester United. Lots of rumors today that somebody's gonna buy it, somebody's not gonna buy it. And here we have somebody fading the rip and perhaps betting that Manchester United will go down. They bought the 20 bucks puts for the expiration date, July 21st, with expectations that the name will go down and lose more than 12.5% of its value by then. They paid about $2.25 a piece. Tenor. This trade, all in all, spending about $3.4 million. And here's a name if we have a rotation trade tomorrow, if we have Powell skipping, pausing, whatever he wants to call it, COF Capital One, that could reignite and move higher. Short squeeze, sure. Gamma squeeze, sure. Because somebody bought the 125 calls for the expiration date, July 21st, with expectations that Capital One would move higher and gain more than 10% by then. They paid about $1 a piece. Tenor. This trade, all in all, spending about $1 million. Continuing with interesting trades, what about the ticker TQQs? This is what we just talked about. This is the leveraged index for the NASDAQ. It moves 3 times what the NASDAQ does in a single day and then it resets. It's good to use in times of volatility. For example, we just talked about a hedge. If you net short the NASDAQ, your hedge should be buying TQQ's calls. You can follow this one if you don't like the one I gave. I see it as a hedge for this week, so I don't see why I should buy it for next week. But anyways, it could also be a bet that the NASDAQ is going to explode higher. that we haven't seen the climax yet. So somebody bought the 42 calls for the expiration date, June 30, with expectations that the name will move higher and gain more than 7% by then. They paid about 85 cents a piece to enter this trade, all in all spending about $550,000. And here it is, NVDA. We'll look at the chart in a minute, but here's another one you gotta be careful with. Because sure, tomorrow, NVIDIA could crash, and that's it, it's over. We saw what happened to AMD today. But now we have a lot of folks, a lot of traders who are looking at Tesla, for example, and they say, okay, we missed the gamma squeeze here. The calls are too expensive. But NVIDIA, the calls are now cheaper than before. So how about we do a gamma squeeze in NVIDIA? And they're buying the shortest expiration dates, mostly this week or next week, like this call right here. Somebody bought the 445 calls for the expiration date June 23rd, with expectations that the name will go higher and gain more than 8.5% by then. They paid about $3 a piece to enter this trade, all in all spending about $1.5 million. The point being is, the chase is misguided, but so is the shorting if you're not experienced. If you say, okay, I'm going to short Tesla or short NVIDIA, you could endure a lot of pain until these names stop and start to reverse. Of course, there is fear of missing out on the upside. A lot of folks chasing. There is fear of missing out on the downside. A lot of traders want to catch the first move to the downside because that's the juiciest move, the flush down. And I would say if you're not experienced, there is a price to pay. And the price to pay is you short right now and the stock goes up 2-3%, if not 5%. It moves away from you. And the experienced short will do one of two things. Either buy in increments, or they have to keep updating the structure over and over and over again. So they short NVIDIA. Then the stock goes up 2%. Okay, wait and see. It goes up more than 5%. Okay, now we have to restructure. Now we have to get out of the trade and buy higher strikes for the puts. So if you're not experienced, what is the harm in waiting? There's going to be plenty of meat in the bone for you to chew on. Sure, you're going to miss the first move, the big flush down, but unless you're Nostradamus, you're not going to get it exactly right. So there's a trade-off. You wait for the move to happen, you wait for the confirmation, you miss the first leg, the juiciest leg, but you got plenty of meat to chew on. Or you want to get the juiciest part, but you have to endure some pain and some risk so you can get that. Choice is yours. We move on to the heat map for the day. What do we see here? The breadth is a lot better. Of course, I would love to see money coming out of the big caps, coming out of chips, coming out of the AI mania, and rotating into oils, metals, industrials, the cyclical side of the stock market. We see some of that, a little baby move of that. You see Apple down, you see Amazon, Google, Meta muted. Sure, Microsoft, NVIDIA, Tesla, those are moving higher. But you can see some of that money coming out of these names. It's coming out of Visa, MasterCard, for example, and it is chasing the rotation. You see Freeport, McMoran, FCX, that's moving higher. You see the fertilizers doing pretty good. You see the metals, the steel, Nucor, that's the winner for the day. When it comes to oils, you gotta be careful with Exxon, not my favorite name. I would stick to the natural gas ones. I would stick to the SLBs, Valeros of the world. And we're gonna cover some charts. But you look at the industrials, for example. The rotation is pretty much concentrated in Deere, Caterpillar, United Rentals. A lot of these names are depending on China. Sure, we got maybe some good news from China today, but is it a guarantee that the Chinese consumer will start spending again? There are a lot of problems in China that are eerily similar to what happened in Japan before. It is sort of a generational change. So it doesn't matter how much the central banks will stimulate the economy. The consumer is not going to respond. And if China goes into a stagnant economic period, such as a lost decade, for example, and ironically, we see Japan reinflating and becoming hot again, will it be enough to cover for China's absence? Can we justify the rally in industrials, for example? The answer right now is no. But for now, the rotation is working, and tomorrow is going to be a big day. Either we get a confirmation or not. We look at banks, they're catching a bid today. Some of the laggards, if you look at defensives, the ticker EL, Estée Lauder, was getting crushed because of China. Now it's moving higher about 3% today because of the news that we got of the stimulus from China. You look at the Chinese names, Alibaba, JD, all higher, but I'd be cautious of chasing those. It's really peculiar to me that Nike is not participating. If we have all of this optimism about China and we're buying Freeport and Nucor and Caterpillar, Deere, the Chinese names, EL, then how come nobody bought Nike? Then we'll look at the automobile manufacturers. Of course, you got Tesla, the mania, the gamma squeeze going on. We also got the ticker TM Toyota, up over 5% today. Now, you know that the only market I've been bullish on this year is the Nikkei, but even that's getting excessive right now. And Toyota up 5.5% for a day, that tells you we're getting closer for a global pullback. And Powell could be the reason. We look at chips, of course, NVIDIA is higher. And then we have the gold rush. What is the next NVIDIA? Is it going to be Qualcomm? Is it going to be Intel? Is it going to be ADI, Texas? But somehow not AMD. Somehow we got sell the news in AMD. We'll cover all of these charts in a minute. But here's the heat map for the ETFs. Again, the good news is it is more of an equal rally. We see big cap growth moving higher, but so is value. So is the mid caps. Small caps, the cyclical side of the economy, the KRE is up, the XME is up for metals, the XLI for industrials is up, the XRT for retail stores is up. Even when we look at commodities, natural gas, UNG, BOIL, the international markets all in the green with the exception of Brazil. All of these are good signs that we have the rotation right now. The question is, we have a massive test coming tomorrow. Either the rotation is going to pass or fail miserably. And therefore, right now, you don't want to jump all in. You want to keep some names in your list, but the easiest way you can chase is what I'm doing right now, having TNA calls. That's all there is. Let's do some charts and then wrap it up. We begin with the hourly chart of the SPY, the S&P 500. What do we see here? We talked about 430. Can't just pass over 430 without the Fed out of the way. It's a premature move. Sure, it is a bull flag consolidation pattern. If it plays out, it's going to play out because of the rotation. We see the SPY outperforming the Qs. But right now, the risk versus reward says, you look at the RSI and the hourly, there's a reason why I'm using the hourly, not the 30 minutes now. Even the hourly is overbought. So you got support 434. That's broken. We go down to 430. That has to be retested and passed after the Fed, not before. Look at the continuous contract for the E-mini futures, for the S&P. Look at this. Most importantly, of course, we have a breakout rally. We're above 43.84.5. But most importantly, look at the volume. The volume is increasing. We see a lot of buying right now. And the buying is happening because of the rotation. We see the S&P all of a sudden outperforming the Qs. Is it going to last? It will last because of the rotation. But boy, you look at the RSI, it's also getting into the overbought zone. So now we have all markets overbought as we head to the Fed meeting and the conference by Powell. So the risk is that everything pulls back. The SPY, the Qs, the IWM, everything. We see sell the news or an upset because Powell screwed up an answer. That's the downside risk. What is the upside risk, Maverick? If we zoom out to a weekly chart of the same chart, E-mini futures, weekly chart, we use the Fibonacci retracement. The upside risk could be yet another 2.5% or so. That'll take us all the way to 45, 28 or so. And at that time, even the weekly becomes really, really overbought on the SPY. Now we'll look at the Qs and hourly chart. What do we see here? Same problem. Above 357, you're not supposed to pass these resistances until the Fed is out of the way. But the psychology says the fear of missing out, get ahead of the Fed and buy because the risk has been to the upside for the longest time. Now this could be proven to be a mistake, a major mistake. And we see a big rug pull tomorrow. We see the Qs down to the 350s, if not 340s even, because you don't want to get ahead of the move, even if you get the outcome you're looking for, which is the Fed skipping. You could see sell the news phenomenon. It happens all the time. Folks buy before the event, and the smart money sells after the event. Once again, the choice is yours. Look at the futures daily chart for the NASDAQ. What do we see here? Above 15,000. And again, I don't think we've reconciled 14,000 to begin with, let alone trading above 15,000. We see the volumes coming out heavy because the retail mom and pops right now are capitulating and going all in. They have the missing out. Now they're convinced that this is a bull market. They've missed it out, and now it's the time to chase. To each his own once again. It's Darwinism, folks. You didn't like it back when it was 13,000. Now you like it at 15,000? To each his own. You see a trend line going on. And if we do have a pullback, let's say a decent pullback, it could take us all the way down to the trend line. That would be a pullback of about 6-7%. And that could coincide with the retest of 14,000. I think that we have to go back and spend a little time with 14,000. When we look at the weekly charts, is there any upside risk left in the Qs? The answer is, unlike the SPY, the answer is no. We've already tapped out here. Max RSI, we have retraced the highs from March of last year. Forget about August. And after all of this accumulation, I'm smelling it. I think we're going to get a rug pull here in the NASDAQ. And even in the most bullish scenario, that the economy makes it, soft landing, no inflation, all of that good stuff. I think once we mark the highs in this rally right here, we're not going to revisit that even in the most bullish scenario for months to come. And honestly, in a big sizable pullback, forget about the 6%, that's going to be the appetizer. But in a serious pullback to fix all of this, you see the NASDAQ going down all the way to the consolidation range from the month of April. And that would be a downside from this point on of about 14%. And I think the Nasdaq, if you take out the AI mania, should be trading at that zone. That's the neutral zone for the Nasdaq. And then we take it from there. Here's the IWM, the Russell 2000, an hourly chart. Do we chase? It's looking good. One would argue a bull flag pattern. You have a little bit of a negative divergence on the hour side, but it is not a big deal at all. Here's the problem in chasing this, and why you have to wait for a confirmation. And the best way to chase this is via TNA calls. If we zoom out a little bit to a daily chart, what do we see here? We talked about the bull flag last night. It is playing out. The IWM is not overbought as we see in the SPY and the Qs. But here's the problem. 189 is a really important number. It was resistance today. Could not make it above it. And you go back in the beginning of the year, 189 was also stiff resistance and stiff support. We zoom out even more, and you can see the importance of 189. This is not going to be an easy number to climb above. And if you want to chase a rotation, you got to look at this chart and say, show me the money. I want you to close above 189 by the end of the week, and then I'm convinced. Then I'm going to chase. But right now, for all we know, given the fact that 189 is really stiff, Powell can come out tomorrow and crush everything. SPY, Qs, IWM, all included. We look at the Dixie 4 hours chart. What do we see here? Went down all the way to 103, the support almost. Now what do we see? The answer is, can't really tell. A break below 103 will be good for metals, but if it climbs higher, and there is a good chance it will pop higher, because there is a good chance that Powell is going to screw up. Why are you skipping, Mr. Powell? Why are you pausing, Mr. Powell? And then resuming the rate hikes in the next meeting. Doesn't make sense at all. He's going to screw up the answer. And the market is going to say, okay, they're going to allow inflation to go higher. Then they have to come back again. So we have to stampede and buy the dollar all of a sudden. If that is the case, it's not going to be good for gold. Still in negative divergence in the RSI and the MACD indicators. The good news is 1928 is still intact as support. You break that, goodbye. SLV silver, weekly chart. Again, you can see the loss of momentum a little bit. I like silver, but you have to be patient. You have to wait till the Fed is out of the way. Because you look at the daily chart, here it is, big engulfing candle, and we could lose 21.57. You gotta be really careful. You can argue we have a reverse head and shoulder formation, sure. I can see it, you can see it, everybody can see it. But you gotta wait till the Fed is out of the way. We look at Brent oil, big rebound today. Is it enough? The answer is not quite. We failed at the top of the reversal candle yesterday. Not a big failure, but could it make it above it? Can we get another chance tomorrow? Sure. Can we get it all the way till the end of the week? Sure. But at some point, by the end of this week, the chart has to close above the highs of yesterday's candle. Otherwise, it's toast. We look at the daily chart for the 2-year. What do we see here? It is above 4.59. What do you know? Today, we got the CPI. Everybody assumed that the reading is cool. Yields are going to go down. Yields went higher. Yields are saying, Powell, do it. Raise. Don't skip. We look at the VIX 4 hours chart. What do we see here? The obvious, of course, is this could be a reverse head and shoulder formation. We get above 15 after the expiration of the VIX options tomorrow. And we see the big squeeze all the way to 20. If not beyond. But if you happen to be bearish volatility, you could zoom in to the 30-minute chart, for example, and say, look, Maverick, there is a failure at 15. And it appears that the chart is making a bear flag pattern. And maybe you can look at this as a head and shoulder pattern. We'll see who wins. I think you know where I stand, and I put my money where my mouth is. We'll look at Apple, the big kahuna, hourly chart. Anything to see here? The answer is not really until we get a break one way or the other. Either it breaks above the top of the reversal from last week, the goggles reversal, or it breaks 177, better yet 175.38, and then we're talking. But that's a long way from now. You look at the weekly chart. What do we see here in Apple? Also getting overbought. The evidence is mounting now. And I'm looking at 169.69 as the pullback target. We look at Tesla, daily chart. What do we see here? This is the absurd now. The most overbought RSI ever. The best scenario for the bears is you want Tesla to gap higher in the morning, and it closes 265.25, and then it gets crushed, and it makes a big engulfing candle, and it closes below 249.16. Because if that happens, you will not see that high in Tesla for a long, long time. We're talking years, not months. What is the white line that you see in the map or the chart right now? That's the 20 days moving average, and it acts as a magnet. You cannot diverge from the 20 days moving average by a lot. You have to snap back. And in this case, if Tesla does snap back, by that time, the moving average would be at around 220, 225. We have a gap at around 230. So if you're going to short the name, you can play with these numbers. You can use them as a guideline. 230 if you want to bet that the gap is going to be closed. Let's say 220, 225 if you're betting a retracement, or betting on a retracement, I should say, all the way down to the 20 days moving average. You want to be more conservative, then you do the 250. which is the break of the last support. And by the way, a lot of you want to short Tesla. Why don't you shop around? Look at Tesla puts. If they're too expensive, you got inverse indices for Tesla. You can buy calls on those. Maybe it is cheaper. So I would say shop around. And if you happen to be a chaser right now, you're out of your mind. It's over. We're getting really, really close to the end here. And if you happen to be along the name and you're not using any covered calls to raise cash, you're not buying any puts, you're also out of your mind. You're too arrogant. You need to use a hedging strategy here. A, to lock your gains. B, to raise cash. What is the harm in using a collar strategy? We'll look at NVIDIA NVDA 30 minutes chart. What do we see here? It managed to trade above 405, and now we have a lot of folks buying the 420. They're aiming for 420 for the obvious reasons, of course. We can see that all the way in the morning. So here's what could happen. We see NVIDIA at 420 by the morning, and if that happens, I would be shorting the name. Because at 420, it's going to be really overbought, and here comes the FOMC, and we're going to have sell the news. So 420 becomes a slam dunk to short. Right now, not really. Not until we see a loss of these two support lines. 405, 395.65. And here's AMD, a daily chart. Look at this. This is a massive reversal / engulfing candle. It did not lose 122.5. That's the good news. But look at the volume. Heavy volume. Fading the rip in AMD. Negative divergence on the RSI. This could be a leading indicator that it goes down, then NVIDIA goes down, then Tesla goes down. And we see the recent gamma squeezes also frizzling out. Keep an eye on AMD. It is now becoming a really good indicator for what's about to come. And then we have requests from the viewers about EQT and Ford. We talked about EQT, the fundamentals and details. You watched the video. You know that I'm bullish EQT. The fundamentals are good. They have survived perhaps the worst natural gas market ever. But if you're not in it, do you buy it right now? The answer is, let's take a look. Here's a 30 minutes chart. I identified 39 as an important resistance. If it cracks above, you got your confirmation, you can buy. But if not, you want to wait because you might get a pullback, 38, closing the gap, who knows? And it gives you a better opportunity to buy. We look at the weekly chart for the EQT. Look at this. Positive divergence on the RSI, positive divergence in the MACD, but 39 is really, really tough. You want to see a closing above it from a weekly standpoint. Then you got a confirmation that this thing will go all the way to the highs. Now, when it comes to Ford, it is within a consolidation range. Here's the weekly chart for Ford. Am I really excited about this stock? The answer is absolutely not. But it could benefit from a rotation. So keep an eye on it, but from a fundamental perspective, I'm not a fan. The Mustang Mach-E is a bust in my opinion. It's not a good car, and they have no ideas. The Broncos are shit. They only got the pickup trucks. And then of course, a lot of you request SLB, Schlumberger. Let's look at this one. Weekly chart, you got 48.88. A weekly closing above this number, you got a confirmation, higher we go. So you gotta wait for that break. Otherwise, there's a chance it could go down. And then we have MOS, Mosaic, again, weekly chart. Look at this. A lot of pain this year. But if we have a cyclical rotation and we have a recovery in China, this is the kind of name you want to be in. Is it out of the woods right now? Not even close. I would rather see it trading above 38.23 from a weekly perspective, and that could be the case. We could be seeing a double bottom right now, and MOS trades higher. Do you buy it right now? The answer is absolutely not. But if you want to bet on it, you can buy call options. That's the safest way. Then we'll look at the German DAX monthly chart. We're still looking at a double top for now. It did not make a higher high, but the RSI is improving. It will be an important day for the DAX tomorrow because if Powell triggers a global pullback, my hunch is the DAX goes down all the way to the trend line. And here's the Nikkei, and even this one is getting absurd right now. I've been bullish the Nikkei. It's the only chart that I like in global markets, but the monthly chart has a little bit of room to go. It is at the magic number of 33,000. It is now at the highs from 1990. When you look at the weekly chart, oh boy, it needs a pullback. And I think Powell will give us the pullback tomorrow. And then we can talk. Do you buy the dip in the Nikkei or not? And last but not least, tulips, Bitcoin. What do we see here? Lost support, big day tomorrow. It's going to move based on the dollar. If the dollar goes down, it goes higher. If the dollar goes up, goes down. But again, if everybody's talking about a bull market and we have to buy this and that, then how come Bitcoin is not participating? No love for tulips all of a sudden. But a couple of years ago, everybody talked about, oh, Bitcoin is going to be 100,000. Cryptos are going to be a multi-trillion dollars market. But I guess this hype is over now, and we have a new hype, which is AI. This is a really important chart to watch tomorrow. It could flush down big. and that will happen if the dollar gains. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? Right off the gate in the morning, we have the PPI, the Producer Price Index. It is important, but it is not as important as the CPI. And then, of course, we have the big dog, Powell. All eyes on Powell. Get him stoned, please. Get the man stoned. And before we go, if you happen to be a member of this channel, we got portfolio reviews coming out tonight. It could be a little later. Still working on them, but you're going to get them in the morning. That will be an exclusive video for you. 2 portfolios, classic mistakes. We have to restructure these portfolios, and I'll show you how. I'll give you names. We'll look at the fundamentals. Which name is better than the other one? We'll look at the charts. So it is an important video. It might not be your portfolio, but you can learn from the example. And the other announcement is we're going to resume our geopolitical / macroeconomics coverage on the public channel after the FOMC tomorrow. So we do the FOMC review, and then Thursday, we're going to resume the public coverage for macro geopolitics. So stay tuned. But for now, this is all I got for you. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
No, seriously, come on, do it. Do it.
Will you stop with that?